Welcome to the Meetup of the Multifamily Minds, first ever Brainstorm. Okay, so tonight we have a great panel. My name is Jesse Almaraz. I'm with the managing partner of Matador Equity. My partner in crime is Jose Rivera. He's with Verini Real Estate Investments. And we are multifamily and self-storage syndicators, as well as co-organizers of this meetup. I'm super amped up because we have a great panel that is some of the top minds in the commercial real estate space. And the other reason why we're pretty excited is not only because of our panel, but April marks our 1 year anniversary of our meetup. So, oh man, I was hoping that you could see him. We got a little guest. That wanted to say hi.
There's Toby there.
Oh man, look at that guy.
He's got a blinking light.
There's Toby there.
Nice.
Happy anniversary. He didn't know what an anniversary was, so he put on his birthday suit. He put on his birthday suit for us. So he thought he's our biggest fan and wanted to say hi to everyone. All right, so me and Jose met about 3 years ago at a 3-day weekend conference, multifamily conference. Stayed in touch. We were both from San Antonio. And about a year ago, we both had to hit a point where we felt like we needed to create some type of thought leadership platform. So we created this Meetup of the Multifamily Minds. And like I said, we're going a year strong at this point. So we want to thank everyone that's joined us tonight, everyone that has showed up live to our live events, all those that followed us here, and all those that are new joining us tonight as well. So we want to thank you all, and we're very grateful for all of you. We also want to make a quick note, a quick mention to all those that have been affected by the COVID, victims of the COVID. We also want to show express our gratitude to all the frontline workers and essential workers that have put themselves on the line to fight the good fight for all of us. So with no further delay, that's enough about us. What I want to do is give Jose the honors of introducing our distinguished guest for tonight.
Yeah, so what we're gonna do is we think the best way would be to let the superstars to introduce themselves. If you can take maybe 30 seconds of your time to tell us something a little bit about yourself. Starting, if you can mention where are you from, so we know people know where you are from and investing, and also what's your current involvement in real estate. So if you can start with Jorge, you can get started there.
Yeah. So my name is Jorge or George, and I'm originally from South Florida, from Miami, and I now reside in Dallas, Texas. I'm a multifamily syndicator. Been doing real estate overall for about 13 years, and now I just focus on multifamily.
All right. Let's move to Steven, good friend Steven. You want to tell us a little bit about yourself?
Hey, congrats on the 1 year anniversary. I mean, it's difficult to make it to 1 week. So, hey, 1 year, that's a big deal. Congrats.
Yeah, thank you. Thank you.
But yeah, my name's Steven Garcia. I am originally from Los Angeles, California, born and bred. Lived outside of the country for a good 6 years of my life. So I like to travel. I speak 3 languages, something that most people don't know about me. But yeah, I am the asset manager and acquisitions manager for Michelson's investment group. And we first started off buying single family properties, buy and hold sort of strategy. And now we focus 100% on smaller multifamily properties, particularly in the B and C type asset class. So, you know, it's funny, I live in California, but I do not invest in California. We prefer to go to places that are landlord and business friendly. So we've done deals in Arizona, Texas, and Florida. And, you know, I'm just pretty grateful to be, you know, part of this power player panel of individuals. You know, I don't know how I got invited to the table, but I'm happy to be here. So, yeah, I'm just curious to find out what's going on, you know, personally and professionally, and in these very, very interesting times.
Thank you, Steve.
All right. Thank you, Stephen. Zar, if you can tell us a little bit about yourself.
Sure. My name is Zar Haro. I'm an intermediary, basically mortgage broker and investment sales, or JLL. JLL is a world's second biggest global real estate intermediary doing leasing management, investment sales, capital markets. And I've been doing and specializing in the apartment business since 2006. Done over 300 transactions between sales and capitalizations, and have experience doing everything from $1 million to $1 billion portfolio. So we have a really big breadth of talent, and within our San Antonio office, it's myself, Moses Siller, and Robert Arzola are the local brokers within San Antonio, and that's what we really focus on, San Antonio and secondary and tertiary markets throughout Texas.
Cool. And correct me, sorry if I'm wrong here, but you also not only brokerage, but also actively invest, right?
Yes.
Are you involved in active?
I do actively invest, not on behalf of JLL, but personally, most of my
Correct. Yeah.
Limited partner position. I'm by far not an operator. I can't lift a hammer. I don't even know how to change it. But we're in the middle of the market, so we get to see some unique opportunities pretty often. So we do invest as well in the LP position, and sometimes if we get invited into the GP position, if the deal's hot enough and the sponsor wants to give us a piece of the GP, sometimes we'll participate there as well.
Awesome. Thanks for being with us. And last but not least, Mr. Kenny Wolf.
Hey guys, thanks for having me, Jose and Jesse. Appreciate it. Wish that we could be there in San Antonio. I like it down there, but it's good margaritas. But anyways, so I'm here in Plano, Texas. Here at our office. But anyways, we are. I'm president of Wolf Investments. Started over 9 years ago, buying multifamily assets, and started out in Dallas-Fort Worth, and have grown to over 4,000 units spread over 5 states. We also acquired triple net properties. So we just bought one yesterday to add to our portfolio as a Family Dollar up in Newark, Ohio. So
good, congratulations.
Thank you. And then we do ground up development. We're working on our second ground up here in Dallas-Fort Worth. It'll be about 88 units as well. So we stay pretty busy here at the office. Happy to have you.
And for folks that are listening, as you can see, we have a very diversified panel here. We have people that invest in existing property, development, from the brokerage side as well, limited partnership, and pretty much all sides of the business. So we're looking forward to bring value to everyone here.
All right. So our topic of the night is the COVID wormhole, COVID-19 wormhole, excuse me. And so, we took the analogy of using a wormhole for our meeting tonight. And Jose actually explains a wormhole a little bit better than I do. So I'll let him explain the wormhole. Okay?
Yeah. So kind of for the people that are not familiar with this kind of a concept, started by Mr. Albert Einstein and Nathan Rosen in the early 1900s, where they developed this idea where two distant locations in space and time could be connected by like a tunnel, space-time tunnel, which makes the distance shorter. So what basically the analogy here is we have the pre-COVID world or universe and the post-COVID world, and we are right in the middle. And that's our focus. We want to be able to talk a little bit about where were we before, things that are happening now, and then what do we think could happen, or maybe a little bit of the ideas, opinions, or thoughts on what could be later down the road with the way things are going with COVID. So just if you want to
so the
take over and jump in with that.
We came up with the wormhole. So everyone has, in the last 30+ days, everyone has experienced their own personal little wormholes, whether it be through real estate, through their own business, through, you know, losing employment. Everyone has experienced their own unknown journey. These wormholes, everyone's experience is different. And so we wanted to talk about that and have our distinguished guest here talk about their wormholes in this real estate space. But we wanted to bring we wanted to start the wormhole in a specific time. Because when news first broke out about the COVID-19 or coronavirus, it started off as more of a China problem. And then it spread through to some of the Asian countries. And then it hit home for us, me and my wife, because she's Korean and Korea got hit. And so we were concerned about her family and her parents. And so that's when we really started paying attention to the virus. Others of you are probably more educated in world economics and worldly news, and maybe you were tracking a little sooner, but that's when it hit home for me. And then it became more of a European problem. And then it hit home for all of us. And then around that time, things really started to accelerate pretty quickly once it hit home. Borders got closed, and then we started having distancing, and then we started having lockdowns and shutdowns. So where we want to really start our wormhole with all of you is right around the point where we were starting to distance. It hit the States. We were closing borders. And it was right before we were having rumors of a lockdown. None of us really knew what a lockdown really meant. I heard people talk about martial law. I mean, it was getting really, you know, and everyone was stressing out, you know, there was a human side of us and there was a business side of us. For all of us that are on this panel, you know, we have the two sides of our mentalities. So I want to kind of take us right there to that point in space, right before the lockdowns. And the first question for tonight is going to be, how long did it take you to realize the impact that this crisis would have on your life and your business? All right, so I'll have one of you step up and kind of take that and kind of think about right when it happened, the human side of you, the part that we had to be a little sensitive and empathetic, but at the same time, we had business to attend to and like make stuff happen, right? So talk to us about when the shit hit the fan for you guys, basically.
I'll take a stab at it. I mean, this is weird, you know, it's a good question. It makes you think about, you know, what was happening. The thing is that, you know, this whole event was not like an event like 9/11, right? Like during 9/11, I knew what I was doing, who I was with, and what was going on at that time. So this was like a little bit different because it was a slow trickle effect and it took a while for it to sink in. I remember when I first heard about it, you know, this thing going around in China, it was like, okay, it's some virus that happens all the time. It's not gonna affect my daily life. So I dismissed it, and then all of a sudden it hit Europe. And once it hit Europe, people started taking this seriously. I think at least the Western world, right? That's when you saw the gyrations in the stock market, you know, and people were like, hey, what's gonna happen? Is it gonna hit North America? So it was a slow, I guess, draw for me. And I didn't think it was going to be serious. And I guess, like, you know, on a personal level, I think when it really hit home is, I guess I have to relate it to my kids and their schooling. I think it was like mid-March when we got the communication from the school and they said, hey, you know what, we're going to close school down for 2 weeks. And this was, like I said, like beginning March, mid-March. And then all of a sudden a week goes by and they said, oh no, that's going to be prolonged. It's not going to be April 1st. We're going to kick that out to April 20th. Another week goes by. And then all of a sudden, sorry, it's May 1st. And then, you know, just recently they said, hey, you know what? School is canceled for the entire year. And so, you know, personally, you know, we're stuck in our house and we're trying to homeschool our kids. And it's not easy. You know, I know Jorge has children too, and it's not easy when you're homeschooling kids because their attention spans are so short that it's one thing to try to get their attention face to face in a school. But when you try to put that virtual system of learning online, then these kids, it's not so easy. You know, they're like, we're constantly trying to fight with these kids to get them to go to the computer, to get online and to do their classes. It's been a constant struggle. So personally, I mean, that's when I knew this whole thing was going to be a little bit different, is when our schooling said, hey, you know what, we're going to have to cancel class until the rest of the year. And then funny thing is that I had a conversation with my sister-in-law. She works for the Los Angeles Unified School District here in LA. And just last week they had a meeting, and this is nothing solid. This is nothing concrete, but there's discussions. I think at this point, it's only discussions, that there's conversations where they're actually talking about having the kids come back to school during the first quarter of next year. I mean, that blew my mind that they'd even talk about that. You know, I'm like, wow, that's serious. But I mean, business wise, I mean, I think that the moment where I felt like, oh shit, this is real, is when they said that all non-essential businesses need to shut down. And as a real estate investor, that got me real scared, you know, because as a real estate investor, we depend on jobs to fuel demand for real estate. And, you know, when people aren't working, they're not getting paid. And so I realized that if I have tenants that lost their jobs, that's going to be a real problem for me. So that hit me hard. And then I started to panic, and I started to, not panic, but started to communicate a little bit more with everybody that I knew within the real estate industry, especially my property manager and my lender. But the thing is that we go through this all the time as real estate investors, right? We have people that lose jobs, and, you know, I mean, people come, people go. That's part of the natural process of real estate investing and operations. Yeah. But when you have 26 million people that lose their jobs at the same time, I mean, that really is concerning as a real estate investor. And I'm just trying to figure out how we're going to get through this, and, you know, what it's going to look like in a couple months.
Cool. Awesome. Zar, Jorge, Kenny.
So one of the
can we do a timeout real quick? I'm sorry, Zar, let me interrupt. But we didn't kind of set the guidelines up front. If we could try to keep it to about 3 minutes. We don't want too general. We do want you to get in depth and kind of tell us.
We have a lot of material that we want to cover.
Yeah, but about 3 minutes if you could, please. Thank you.
My bad.
No, that's all right.
No worries.
Not too much.
The question was, when did you realize that your business is going to be impacted by it? So
your life and business. So one of the advantages of working for a global company is that you get to see some of the things that are happening. And, as the contagion was happening in China, we have employees that work there as well, doing the same exact thing that we do: brokerage, sales, et cetera, management. So we were able to figure out pretty quickly that it was going to be pretty challenging. So really when it hit me personally is we came back from a conference in late February, early March, and I was traveling in Los Angeles. And when I get back to the office, an email comes out 2 days before that says, if you've been to these places, you have to quarantine. And we were a little bit confused as to how to interpret it. And I wasn't ready to quarantine. And then I looked at the papers, and it said, okay, you're fine if you didn't travel internationally. But if you traveled to a city that had a COVID outbreak, you had to quarantine for 2 weeks. I walk into the office, and everybody's looking at me like, you need to get out of here. And that's when it hit me that it was real. And you're almost in denial, going like, I don't have it. No way. I washed my hands. And so that was really the challenge when it really hit me. And then the next week we went into the JLL as a company basically said, hey, look, it's time to go back home earlier than the stay-at-home orders for varying cities or states. Just they didn't really want to take that risk, which I recommend them in. But really where it started to affect is that, I mean, at the end of the day, we're a laptop, and the startup capital to be an apartment broker isn't that expensive. It's a laptop, phone list, and email list. So you can kind of take that anywhere. It's really the relationships that matter. So that's really where I think that made the biggest difference from being able to work from home. But I do applaud all the operators and all. I don't want to
steal Kenny's fire, but at the same time, it's really, there's two things that are going on. Is one had to be the operations and understand how to operate remotely. And then two is we realize that it's going to be a challenging situation and how to be prepared to take advantage of some great opportunities that are going to come down the way. And that's really, we as apartment brokers, is trying to figure out who's going to sell, who's not going to sell. There's going to be winners, there's going to be losers. At the end of the day, the market's going to polarize. The likelihood of the institutions will go to a flight to quality in Class A, and the B and C investors are going to go to foreclosures, and the B market is going to be somewhat paralyzed for a little bit from a sales perspective. Operationally, I think they'll do fine. But, you know, we can talk about that a little later, but.
Yeah, exactly. We're going to actually get into some of that a little later.
Yeah.
Thank you, Zar.
All right. Thank you.
All right, guys, I'll jump in. So we've got a lot going on. So I was actually I spoke in New York City, March 4th and 5th at two different meetups. The next week I was in Boston, and then I flew into, I'll never forget, my daughter and I, she came with me on a business trip to Cleveland, Ohio. We're flying in, and that night we touched down about 10 o'clock at night, and they were closing all the restaurants at midnight in all of Cleveland. So I was like, I don't know where the heck I'm going to feed this kid. So we land, we go to the hotel. A colleague of ours, he owns a pretty high-end hotel there in downtown Cleveland, and I was one of 5 people in the whole entire hotel that night.
Oh.
See that, like, with them shutting down the restaurants and all that, you know, on a personal level, like, so we had to, there's one grocery store downtown Cleveland, so we had to go in there, buy our food, and take it back to the room. And now we're kind of used to that, right? But then it was like, this is so, like, I can't sit down. There's a table right there. So anyways, that was one aspect to it on the personal side. Seeing it like that. And like on those 2 meetups there in New York City, half the people showed up, and same with Boston, because they were starting to feel it too, the social distancing. They were already kind of doing that. And then business wise, you know, really we had 5 closings going on before COVID-19. And so all 5 are going through. One's a sale here in DFW, one's a refinance in Cleveland, and then there were 3 acquisitions. So one's a HUD assumption, one's a redevelopment kind of deal in Ohio, and then third was that Family Dollar we just bought. So being able to see how the lenders have treated this all the way through, honestly, for me, I've been less scared, I guess, than other folks, because I've seen that they're actually lending. So all those 5 closings, all the lenders have not changed their term sheets one bit. That was pre-COVID-19. And then I'd say probably it feels like every other day, we're getting a call from a new lender wanting to lend money. So to me, you know, seeing it from that side, this is not 08 and 09 in my opinion, because they're actually lending. That was the problem in 08 and 09. The lending stopped. That's not the case. I mean, we just locked in a term sheet at 3.6% interest rate locked.
Oh, wow.
Wow. That's
so to some of this, you got to take advantage of, you know, lock in those low interest rates. Because we're moving from a 5.5 to a 3.6. I mean, that's massive, right? Now on the operations side, you know, obviously, you know, for April we were 0 to 10% lower on collections than.
Okay, well, we're gonna dive into some.
Yeah, we're gonna go there, Kenny.
Yeah, so we'll definitely go in there. And also the lending. So you'll be a good one to talk to start off the lending.
Yeah.
Go ahead, please.
All right. Yeah. So I'll try to keep it short. So as far as I was probably a little bit late into the news of COVID, like before this all happened, I purposely never watched the news. But
same here.
Yeah. So we're in the middle of, I do remember this though, we have a $10 million CapEx going on in some properties in Houston. And we were down there with the whole team. We're in the middle of the project, and we had finished a whole day of checking on the projects, and then came back and we're going to watch an NBA game, basketball game. And
which one? Spurs right there?
I don't think it was the Spurs. I think it was the Heat. Nah. But they canceled. That was the day that they canceled NBA. You know, because I forgot who the player was that came up positive. Yeah.
Positive, yeah.
So that's when it became a little real, and I started looking more into what this was. And then I think we have a pretty optimistic president, and you know, tries to say very positive things. And then he had his press conference where he looked like he was the most depressed president I've ever seen, and that's when I think it really hit me like, okay, something's going on. And then I think they shut down the businesses. You know, I also own a construction company, which I didn't talk about. I was lucky in the fact that here in Texas, they named construction an essential business.
Essential,
so,
yep.
You know, we have had to make some adjustments and whatnot. But man, I can't imagine, you know, being one of the business owners of a restaurant or one of those industries. And yeah, I mean, I don't want to go. I know we're going to go into more detail on what it's done for multifamily and whatnot. So.
Yeah. So
right.
I can take the next one, Jesse, if you're okay with that. So yeah. So going again on the questions. So we briefly talked about, you know, 08, 09. Kenny mentioned that from the lending standpoint. But the truth is, you know, what happened in 08, 09 was on the financial side. Now we're talking about health-wise. We really don't have any or much information to compare with. There's not much similar
historical data. Historical
data to compare to. So, you know, what are your takes? Again, if you can take a couple minutes to keep it simple, things that you are looking at that might be similar and things that you're looking at that are completely different, and you're having to put something new together to get you to where you want, demographics or now financial analysis, anything like that. If you want to, Kenny, you want to start with that one?
Yeah, sure. Can you repeat the question or just say it again?
Yeah, so basically, so since this is not 08, 09 crisis, it's completely different. Is there anything that you feel like you can still take from 08, 09 in terms of helping you take a little bit of the uncertainty out of the current times?
I want to add something to it too, because we also have situations like hurricanes. So we're in like a recovery, or we're in a situation where we don't have any historical information on how to recover from this type of pandemic or health crisis. So that's kind of what we're trying to go with here, and kind of compare the similarities, what we can take from it, and the major differences.
Yeah, sure. So I hope everybody was with me buying a whole bunch of stock in March, because I was looking at my lowest gain from mid-March was 20%, my highest at 91%. So the similarity is in 08 and 09, I actually was not in real estate. I was in oil and gas, and I was buying as much stock as I could in 08 and 09. And in 2010, I sold all the stock and jumped into multifamily assets. That's kind of how we got our seed money. So that's kind of a similarity, is I'm using cheap paper right now to double our money or more on those assets, and then we'll flip it into real estate. So that's a similarity on that piece. For real estate, this time is different because it's not, we have low interest rates, people are lending, and there wasn't anything systemically wrong with the economy before 08, 09. There wasn't the fraud that was happening on in 08 and 09. So personally, I think this is a 6 to 9 month window, guys. And I think if you have a stable property, like Czar said, if you're a B, C, or A stable, even if you're C, if you're stable, you're just hunkering down. You're not going to sell. Why would you sell right now? Because the lenders are willing to do forbearance. And we've seen that from colleagues, not just on Fannie Mae and on agency, but on actually like hard money lending folks willing to forbear and push stuff back. So I think you're seeing more of a team effort this time on the lending side than you did in 08 and 09. To me, I think as these states open up, you're going to see jobs come back pretty quickly. And most of the jobs that were lost are the hourly folks, restaurants, bars, stuff like that. So, and those folks are always the first to be hired, the first to be fired and the first to be hired, right? Those are kind of jobs that we can plug back in pretty easily. It's the PPP program. We just got approved for it today for Wolf Investments, so that was nice. That's helped a lot of us businesses be able to keep these folks on for an extra 2.5 months. So really, I think it's going to, and also it's going to be a tale of what state you're in. I mean, Texas is going to start opening up here pretty soon, May 1st. Oklahoma, Louisiana, and Ohio and Oklahoma on the same path as the states that were in multifamily. So, I don't think we're going to be hit as hard. We'll see. May 1st is coming right around the corner, so we're all kind of to see. But with the lenders being able to forbear, things like that, and they're open to it, I don't see a big dip in pricing on our side.
Okay. Anybody else? I'm taking that one.
I'll take that one. I'm not as bullish as Kenny. I feel a little different. We hear the despair on the other side from many investors. I would say that Kenny is probably the 20% of people that are very optimistic, but that doesn't mean he's wrong. Usually it's the 20% that is oftentimes right. It's going to be very market specific. And really, I think that you already put out a great report. It's really about the employment exposure that you have relative to what industries that particular market is exposed to. So San Antonio, unfortunately, is exposed to oil and gas. It's exposed to a lot of hospitality, and it's exposed to a lot of retail jobs. So 33% of our employment is at risk. DFW probably has a little bit more diversity and ability to convert to work from home jobs. San Antonio does have government jobs that will increase, and we're seeing that increase, cybersecurity, things like that, military. So those are the stabilities, and we'll hope that those things carry us. Every time we get frustrated when Dallas and Austin breaking records in pricing, and San Antonio doesn't keep breaking those records, it's because of the wages don't increase as dramatically. And we're hope that will be the stable. What we've always been is kind of 3% growth over year, like clockwork. So each one is a little different. So from a lending standpoint, there is a lot of liquidity in multifamily. Other sectors are really challenged. Hospitality, retail. So I will agree with Kenny that there's definitely a lot of liquidity. So here's an example of actually what's happening today. So the Fed is offered to buy $3 billion worth of Fannie and Freddie and HUD paper 2 weeks ago. They only bought $300 million because the market was healthy enough to have enough liquidity just by having the Fed be able to say, we will be the stopgap, created confidence in the investors to buy paper that was backed by the federal government anyway. So instead of buying treasuries, they get a little bit better yield by buying Fannie, Freddie, or HUD paper. Now, there definitely isn't the liquidity in other product sectors. Maybe some of the smaller deals that are maybe single tenant type stuff, the community banks or credit unions will fill that space, but it's definitely not the case in the larger assets, office, things like that. They're having a bit of a credit dislocation. One thing that's different, because I was around in 08, 09 and sold a lot of the foreclosures, bankruptcy, short sales, that was kind of where we made our living at that time. Was what's different this time is I think that the people that were employed at that time still remember how to do that type of sale. And really, I think it's going to be really two camps. There's the people that have what I would call pre-COVID symptoms that were already challenged in their operations that probably are going to have trouble. It goes like this, and this is how the story goes. I was already in trouble. My investors were upset with me. Hey, I'm doing a capital call. Oh, I can't make units ready. And if you were raising at $50,000 a pop, trying to get somebody to reinvest to do a capital call on assets that aren't performing already becomes a very challenging. And then the
uphill.
The tenants get upset, and then you end up throwing your hands up, and you really can't save yourself from it. And then you go to try to sell, and you look at your yield maintenance penalty, and it's more than whatever your equity is. And so the agencies, unfortunately, by the rule of government, they can't really give you a special deal or somebody else a special deal. So the agencies typically have the highest foreclosure because they can't give a special deal to anybody else, whereas the community banks may be able to work an extension and things like that. So that's where you'll see the challenges. Is probably pre-COVID symptoms. You'll see the challenges in people that are coming up on bridge maturities that are a little bit overextended, where there's not enough debt service coverage. But we also underwrote some deals today that we thought were going to be challenged. They hit their metrics in their bridge performance, but rates are so low that, I mean, you can get a 3.25 today, 75% leverage, and the difference between a refinance and a sale is the sale, I have to go actually clear the market at today's pricing. The refinance is what the comps were 6 months ago. So you still have, like, value doesn't really matter today. Give it 6 months and set the new comps, and then you might find a challenging value. But that's where I think that you're going to see a little bit more distress from the operations side, is the people that can't make it through. You can forbear, but we've seen a couple of BOVs that we've done that they've essentially said, you had pre-COVID symptoms, show me your COVID units. Who knows what a COVID unit is? I mean, I think the economy is a COVID unit, but there's also some challenges between the lenders wanting to forbear, because now that lender has to make essentially the debt service payments to the repo line if they're leveraged. And so although they may say they're going to forbear, we're finding that there's a disconnect between the servicer and what their liquidity level looks like, and the actual agencies that are going to, have the mandated forbearance document. So we've seen people trying to go, and they're saying, sorry, you had pre-COVID symptoms, try again. We're not going to help you, because then it becomes a non-performing loan, and the value of that loan becomes distressed. So we'll see if it continues. But the one thing that I will say from 08 and 09 to really remember is you got to do two things. You've got to make sure that your operations are in place, that you have staying power, and you're locked and loaded with firepower to be able to take advantage of these great opportunities. Because if you don't do both, you're just going to let a crisis go to waste, and you're not going to take advantage of leaning in on some really great opportunities. So you got to have staying power and firepower to be able to take advantage.
Yep.
I agree. So, Stephen, do you want to take this, and then on the next question, I think I want to start with Jorge with operations on the next one.
Yes. Yeah.
So, Stephen, I know you do a lot of research, and
I like to read history.
Yeah, exactly. You're a student of history, so I really want you to elaborate on this question, and then we'll move on to operations.
I guess I'll take a different perspective from what Kenny and Czar had, and just recently I was listening to this guy named Richard Duncan, and then he compared, we really have nothing to compare what's going on right now with recent history. So he said, the last time we had a global health crisis was in 1918, right? So that was the Spanish flu. And the Spanish flu hit around the first quarter of 1918, and it, most people don't know, it only killed about 5 million people, which, I'm not trying to marginalize at all. That's a big number. But when the second wave hit at the end of 1918, it killed about 50 million people. So the first wave was nothing compared to the second wave. And the Spanish flu actually makes COVID-19 look like Disneyland. But there's a couple of things that he mentioned, which I thought were pretty interesting. We didn't experience any global financial crisis back then. And number two, the US actually thrived during that time. You didn't see a huge drop in GDP. You actually saw a GDP increase. And he cited a couple of reasons for that. You know, even though this was bigger than COVID-19, the reason that it didn't disrupt the global financial systems or the global market, because there was no global market, right? I mean, the world wasn't as interconnected back then as it is today. So if you feel something in the US, you're probably going to feel something in China. And then he said it really didn't affect the US because number one, the economy was really different back then. We were an export economy, right? We were a natural resources economy, much like China is today. We exported all of our excess capacities to the rest of the world. Specifically, we were feeding all the Allied troops during World War I. So it wasn't a service-oriented economy like we have today. And the reason why we're going through so much peril is because we're such a we have such a heavy service sector that just can't go to work. Back then, it was manufacturing and export. And then number two, he said, which I thought was really, really interesting, is that the reason the US didn't feel anything during that time and actually, you know, increased in GDP was because there was no debt. That's the biggest reason that you see the difference between how the world is reacting today and how it didn't even affect the global or the US economies in 1918 when you had a pandemic, which was much bigger, you know, than what we have today, because back then it was more of a capitalist system where you had gold. Gold was money and it was pegged to $1, and you can only grow the money supply as much as you had gold. So today we work off a different system. It's about credit. The more credit expands, the more our money supply expands, and the more we're able to do things. So that, I thought that was interesting, and that's just a different perspective. But the reason we're in this situation right now is because we have a lot of debt.
Mm-hmm.
All right.
Thanks for that perspective, Steven. So
yeah, that's pretty.
So yeah, if we can move now to on the operations side.
I'd like to. I'd really like to talk about collections. I know I've read articles recently that talked about collections hitting 84%. I think I saw one here that says closer to 90. You know, and I just wanted to get a take, because I believe those numbers are more local. I mean, it has to do with your local market, your little micro neighborhood, and everybody's numbers. Yeah, so it's going to be different for everyone. And so I kind of wanted to get some feedback from you guys. Are those numbers, are you guys hitting those same numbers? Is it similar? I think Kenny kind of briefly talked about it. I liked where he was going with that. I'd like to see where, Jorge, like if you could start us off with that. And also talk a little bit about some of the tweaks you had to do, because now we're talking about going through the wormhole, and we're kind of midway through the wormhole. And let's talk about some of the adjustments that we had to make during this wormhole. So what should operators do to survive this crisis? What adjustments have you made? And kind of touch on collections of rents, please.
Okay, I'll try to get all that.
A lot? Yeah, did I do a lot?
No, you got 30 seconds for all that.
Yeah. So we haven't talked much, man. I want to give you an opportunity to shine here.
Yeah. No, I got you. So it is very area specific. You know, Czar mentioned that. Depends on your residents. You know, our properties on average, April's been a good month. I
think April is probably the best month we're gonna see. I mean,
I only see it going down from here, but I don't know. May not be that bad either, because you've got all the stimulus hitting now. I think June, depending on how things open up, is really going to make or break some businesses. But so with that said, you know, where we have our properties, it just turns out that our resident base wasn't as affected. You know, we have done a good job of communicating with our residents, which is key right now. I think some of the operators that are going to run into issues are the ones that haven't been focusing a lot on operations. And, you know, now they're trying to put more focus on it, but you know, a lot of things are changing. You gotta be flexible. You gotta have a good team, because I mean, building a team right now would be a little difficult as well. So one is, you definitely gotta be flexible, and you gotta be able to do things remotely. I mean, even though we are at our properties, we do have our office open. We do have a staff. More things are by appointments, and we try to, for the most part, do everything remote if we can. But so with that said, I mean, operations is where operators are going to shine right now, or they're going to, unfortunately, that's where the opportunities are going to come. You know, I agree with Kenny.
Yeah.
I think it is going to be a smaller window than some may think, unless what Steven is saying happens, which I also saw that interview, and yeah, that second wave, you know, hopefully we open things up properly and people follow the guidelines, and who knows, you know, maybe a vaccine comes sooner than, I've heard several times that maybe September we may have a vaccine, but who knows at this point. Yeah, I don't know. What else can I answer there on operations? I know you want to kind of focus on that.
No,
Is there anything, if I can jump in, for example, you know, a lot of the product that we as investors look at on existing properties, value add and doing renovations, have you had to just stop cold on renovations to rearrange and regroup on this season or this times, or have you continued to do some renovations on your projects, or how is it working from the renovation standpoint?
It's been property specific. So, I mean, depending on where you are, at least for us, you know, depending on where we were in our CapEx and our business plan, for instance, in the properties in Houston, which we just closed on in late November, I mean, there were some projects that we just could not stop, and it didn't make sense. We did revise our scope and put more reserves to the side versus spending it all on the CapEx. But there's still, we want to be ready. You know, we want to be ready when things open up. We want to have a good product that we can, I mean, that's one thing I didn't mention. I mean, we've actually had more traffic than we did before at our properties, and our occupancy is going up. So, I mean, it's not like people still need somewhere to live. So we want to, you know, we want to present a good product to them. To do that, we've got to get some stuff done. We can't just completely shut down. So, and then there's some properties where we had done the bulk of the CapEx, and, you know, some of the things that were kind of lingering weren't too important in our business plan, so we kind of put it to the side. But we are putting a lot of focus on still getting the traffic. We've kind of rearranged where our marketing is going to get that traffic. But yeah.
Hey, Jorge, since you do have experience with the construction side as well, let's just touch on that slightly real quick. Have you seen a problem of lack of like materials, a lack of sourcing materials, shortages?
The supply chain?
No. Any delays, any prices of materials going up? What are you seeing on that side of it?
Nothing major, guys. I mean, we're flying through our projects. On one of our new developments, we did run into some issues with, pretty much if it's a specialty product, you may run into an issue. But for the essential items, we have not. The labor force is out there. They want to work. They're willing to follow the guidelines that we've put in place.
Mm-hmm.
I mean, we're getting a lot done, and I think we're doing it. Feels like we're doing it safely.
Excellent. Good. Kenny, can you elaborate on what you started earlier on this question here?
I'll talk to you later, okay?
Yeah, so I mean, on operations, I mean, our collections have been better on the our A-class deals than our B's and C's, right? But I mean, the C's, I think the worst one is a 10% off collections for April. So I don't see a big issue there for April. It sounds like we're hitting the averages. We're in 4 different states, so we see, you know, we got a pretty good look at least the fairway of the United States, not the fringe, right? Florida, California, New York. That's a totally different story, right? So the states that we're in, we're seeing, we're seeing leases. We had 7 leases on one of our C-class properties. last week. I mean, we're seeing traffic like crazy. I think it's boosted our traffic for our 3 bedrooms because the kids are home now. Usually the 3 bedrooms didn't go in May, but now we were seeing stuff. Our 3 bedrooms fly off the shelf in March, you know, so.
Wow.
I think that was, that's something that's been interesting. Yeah. And then having to move to like, you know, online showings and or Zoom and like being creative like that has really helped. And I think going forward, it's going to change too, because of the, everybody doing their work orders online, paying their rent online. We've always been able to do that, but now basically the entire property is having to do that. So I think going forward, it could mean lower payroll for us going forward, because we may not need as many leasing agents. Because if folks are leasing online and they see a video tour of a property and then can click and they're in, you know, that's going to speed things up. So I think we're going to see some, obviously, changes going forward. Operations today, I mean, obviously our offices are by appointment only. They practice all the, you know, guidelines to stay safe, obviously. And then our maintenance guys are only doing emergency work orders for now. We're kind of holding off on doorknobs and stuff like that at the moment, just to make sure everybody's safe and all that. But emergency stuff, we got to get in there and fix leaks and things like that. So, so I think there's going to be a massive run on everyday, you know, materials for the property to keep them fixed up. So we're actually buying as many doorknobs and whatever else replacement parts we got to buy now, because I think there is going to be a run whenever people kind of get off the sidelines and start back. But we're pushing ahead on all of our make readies, because again, I think we're going to have a very condensed leasing season, like Jorge was saying. I mean, people are not stopping leasing; it's slower.
They still need to work to stay.
Yeah, they're still going to move, so we got to have ready products. So I just sent a crew out to El Paso to knock out 10 3-bedroom units on the fly because we are seeing that traffic. So
excellent.
Cool. Great. So let's just I'm trying to speed up here, but we do want to cover as much as we can. We talk about operations, and Zar, you talk. We talk a little bit about on the acquisition side. So and this is something, if you can talk a little bit from the brokerage side, but also want to hear it from at least one of the other on the group from the investment side. How is your acquisition criteria changing during these days? What tweaks are you making, if anything, that you can share in terms of the analysis that you're doing to properties today during this time?
So I'll answer that in 2 ways. One as my personal investments, and one as what clears the market as a broker. My criteria hasn't changed. I'm still buying distressed. Somebody screwed up an operation. They're just not performing well. That's what I would invest in, 80% occupied junk. And that's what I have a partner that's a great operator that do great rehabs, and they go renovate them, stabilize them, and sell them to people that want to use agency financing. So that hasn't really changed. We use local banks to purchase that kind of stuff. But what clears the market today, really, I think it really takes 3 steps to really understand, and I think we're past the first one. The 3 steps, really, I think, for people to get clarity on underwriting is financing available? What does that look like? So it took about 6 weeks to figure out what the agencies wanted to do. But now they're underwriting, they'll go up to 75% leverage. Rates are in the 3s. They're going to require principal and interest as a reserve, which is about 5%. If you're at 75% leverage, it's about 5% of your purchase price. So if you look at the 4.5 caps people were buying before, and now say you got a 5, I mean, your equity is still going to be 70% leverage from that 4.5 cap, or it was going to be 65 at 4.5. At 5, now it sizes with lower rates at 75% at a 5, 70% maybe with that extra reserve. But one of the things that I think, as I was underwriting one today, that I thought of is the great idea is just to reserve for that value add. The way that it's going to look is you can get that money back after 3 years. There's like debt service constraints for 2 quarters, after a year, yada, yada, yada. But if you underwrite in year 3 that you're going to do your value add and that 5% that you're going to get, you start using that to go do the renovations in year 3. I think most people are going to underwrite 0 rent growth in year 1, a little bit of distress in year 2 possibly, and then rent growth from there. But the truth is that you already have that money raised and you're going to get it back in year 3 anyway to go do the renovation. Use those dollars. We looked at a $20 million deal and it's $1 million renovation budget. Well, that could be half your renovation budget. So look at the total returns on the deal. So that second is then underwriting operations is going to be key. If you're going to underwrite doom and gloom forever, you're never going to buy anything, right? So you're going to have to underwrite. Probably a little bit challenging 2 years. If you're underwrite, so as a perspective, in the last recession, really the key indicators that people were looking at was what sold was 10% cash on cash, and most people would underwrite 90% effective gross income. So like 90% occupancy, collection loss, yada, yada, yada. So that's where they felt comfortable in underwriting, and then adjusting to whatever today's market rent is. That's what they felt comfortable underwriting. And at 10% cash on cash now is still, you're still going to get 3 years of IO in the underwriting today. If you're at max proceeds, 70, 75. So it's pretty easy if you move a cap rate 50 basis points to get that, call it 10% cash on cash return in San Antonio. That's a 5.5 cap. But pre-COVID, people were underwriting 8, then it went to 7, and then it went to 6 cash on cash returns. And it's like, that was kind of hard to keep going. And that's probably why Kenny went to secondary markets, because you could actually produce a return.
Yep.
We're kind of in between secondary and tertiary, where we're not the majors, but we're not secondary or tertiary. So we kind of are the fall off point for the majors. And so one of the things that really, I think for us was that deal might be 8 or 9 in Dallas, and in San Antonio, it might be 10% cash on cash, but you can make a lot of these deals still dance with 3.5, 3.25 rates at 70% leverage. I think the underwriting is very similar. And then third is once you can present that type of deal to the equity, all the syndicators here, you can't go back to your same old wells. You're going to have to raise new money because those guys might be tapped out, or they might be, in challenging deals. So you guys are doing a great job of getting online, because if you can't meet in person, find new sources of capital, because there are new sources of capital that are forming that have made money in the stock market. I'm doing a lot like Kenny is we sold the deal in Temple, made barely like a 30% return. It was like the worst deal we ever did, dumped it all into the stock market, and now we got 100% valuation increase. And so we're jumping.
Awesome.
Yeah.
So
that's cool.
It's hard to do deals right now. So you probably won't close something for 90 days. And so getting into the stock market, or one of the other ways that we've been seeing foreign investors invest is actually in REIT shares right now, because they're down like 40%. And the net asset value of the underlying real estate is worth more today than the actual share prices. So you might be able to actually, if you need to make money today, multifamily REITs, if you're brave enough, shopping centers and malls, those are like 50% off, but that not my style. I like distress, but not that distress. So I think if investors can get 8 to 10% cash on cash return and the hope of an upside, I think you'll raise money very easily.
I agree on that.
All right.
Whoever wants to answer next, if you could talk maybe something about how you're underwriting maybe economic vacancy, and dive a little bit into that, as far as like what are you changing as far as your underwriting, how you're looking at deals, because everything that we've ever looked at before is kind of wiped off the table. We're still figuring that out as we go. So how are you guys, when we talk about acquisitions now, moving forward, how are you guys doing some of those tweaks? Because we have a perspective from the broker. Now I want a perspective from, we can have a syndicator, or a sponsor or an operator talk about the differences in their acquisitions at this point.
Buy it cheap.
Oh, go ahead, Jorge. Go ahead.
Do what?
No, I was just messing around. I said just buy it cheap. Make sure you're buying cheap.
Yeah.
And I mean, get a dartboard and throw it at the dartboard. I mean, we don't know where.
Yeah, there's such a disconnect, it seems like, between sellers and buyers right now, right? So the sellers want to talk about the future and the buyers want to talk about the past. I mean, vice versa. Sellers want to talk about the past, buyers want to talk about the future of where things could possibly go. So
yeah, if you wanna do acquisitions, I mean, you've got to find somebody that has a reason to sell right now. I mean, it can't be somebody that's thinking about selling, or no, they have to have a loan that's coming due pretty soon, or something's happening where they need to get rid of the property. I think somebody mentioned it earlier, or might have been another webinar, where, I mean, nobody with a property that's doing good is going to sell right now. It makes no sense. So I would start there. You know, you got to find somebody that needs to sell.
We just hired I just hired a new acquisitions guy 2 weeks ago. So yes, sorry, I am bullish. Because we were I was getting so many phone calls about, I think we've looked at 8 deals in between Texas and Ohio, where they just want us to come in and assume the note. And, you know, so that's the kind of deals that we're looking at right now. All the stable stuff, you know, today, you know, is you know, people are just hunkering down. So you've got to focus on the deals that were messed up before COVID-19, as Zar was saying. So you've got to look at those. But I mean, I think I think 2 on the hook that we're just going to walk in and assume they're Fannie or Freddie debt. And take over, then just take the keys. And it's going to be an awesome deal. But again, you have to look at the total return. So you have to be talking to your investors saying, you know, this is not a cash on cash play. We're walking into, you know, we're trying to fix the truck here, make sure it's going to get back on the path to progress. So that's kind of what
I'll say I'm bullish on those deals too.
Okay. All right. Yeah. I mean, we're a long-term investor, right, in real estate. So if you're a long-term, then you gotta, you know, you gotta look to see what the market gives you today. And right now it's the pre-COVID messed up deals that you can, you know, just walk in, hopefully just assume their loan. They may not like it, but there's at least a few talking to us that I think it's going to go through. So
how would you guys structure that financing? Because I know some of the lenders are waking up now. And I have had some luck talking to some regional banks, but you know, if it's something that's under 90% occupied, and this is for Czar or Kenny, how would you structure it?
Thanks for taking over my show, bro.
Have a co-host.
Sorry.
Add an organizer to their list.
It's all right. It's all right. This is what we want.
If the loan's already in place, you're not originating a new loan. They'll probably require 6 to 12 months debt service reserve, and then some sort of shortfall reserve. So there's some equity that's going to go into it, but the agencies are typically going to be ecstatic that somebody's going to actually breathe some life into this thing. That is, you have to be better than the borrower that they have in play.
Yeah.
And, you know, Kenny has a great track record of being able to turn the properties around and have good operations. So I think that he'll be able to do that. But that's one of the things that we're trying to figure out too is, so last time from a finance standpoint, in 0809, the community banks jumped in to kind of fill the void for the distressed, like 50% occupied, like they're going to lose the deal, or it was either 100% cash or it was the community banks. But the challenge today is the community banks are right now occupied with PPP, and in Texas it can be a little challenging unless you have like a super good relationship. Like they're now in trouble with some of their oil and gas borrowers because last time Texas Tech and oil and gas led us out of the recession in Texas. But right now we have the double dip with oil and gas as being challenging. And then also we have challenges with, COVID related industries. I guess they're all related industries, but that's what I'm trying to figure out, is how you capitalize those 50% occupied distressed deals. And I'm calling every regional banker and they're like, get back with you, I'm busy. So give it a month. Once PPP,
doing the same thing. That's why I asked you guys.
Yeah.
You give it a month. Once PPP is out of the way, and the other part is that their PPP is causing them to carry more. It's taking more of their lending capacity because they got to carry more liquidity to have higher amounts of SBA loans on their books. So it's pulling away their liquidity. Some of their oil and gas banks are challenged. So we're trying to figure it out. And the bridge lenders, while they're still there, they want the highest quality trophy office building in San Francisco at 65% leverage when the insurance companies are like 50. So that's where I'm trying to figure out. So if anybody wants to be a private lender at 4.5 interest rates, let me know.
We've been doing some lending too. So we just funded a boutique hotel in downtown Dallas, and obviously it's hard money, so people don't want to use this long term, but that's a little business we've kind of created here. So.
All right. Thank you, guys. So now moving on and we kind of, again, sorry, touch a little bit on this. On the money raising side, are you having to, because of the situation, and like Kenny was saying, now we're talking about a lot of opportunities on assuming loans. Are you guys having to tap into other kind of investor, not your typical kind of investor that is looking for the cash and cash, and now I need to move this aside on the parking lot and tap more into people looking for more equity at the end? How are you guys managing your money raising, and what are you hearing from your current investors? Are they getting into panic mode and stopping, or are they still willing to jump in the wagon with you guys? Who wants to take that one?
I mean, I can jump in real quick. So, the private individuals, those type of investors that we have, a lot of them are waiting on the sidelines right now. They, we're staying in constant communication with them, and it seems like weekly they're feeling better and better about it. But we've been focusing a lot on the bigger investors, the institutional or firms, because they've got a lot of money that's either already raised or sitting in a fund, and they need to get it to work. Yeah. So we've been working on those relationships a lot and gearing up for the opportunities. Be able to step in, and like Czar was saying, if we got to come in with 100% cash or equity, we definitely want one of those partners that can step in and help us take something down.
Yeah, I could step in there too and share my perspective. I polled my group of people and asked them if, hey, what you're feeling? Do you feel like this is a good time to go in? And 60% came back and said, nah, I'm just going to sit on the sidelines and ride this thing out to see what happens. And then I talked to my friend who has a bigger network of investors, and the poll came back, similar. About 50% said, I'm going to stay on the sidelines. And there's another 50% that really, wants to take advantage of the opportunities of these distressed properties that we're talking about, because there are, I'm sure there's going to be plenty out there. The thing is that there's a lot of dry powder, man, and you always want to compare the investment landscape right now to, what's out there. So, I mean, compared to the stock market, I know Kenny and Czar are riding a bull market right now, but a lot of people don't feel like the stock market's a safe place to be. There's a lot of volatility. Then you look at the bond market and you're making, 1%, 1.5%. So I mean, real estate still looks pretty damn attractive in terms of returns and the future potential. So there's a lot of dry powder out there. You just gotta, I guess, convince them that, hey, number one, this is a pretty good deal because we'll get cash flow out of this. We have our plan. Here's our plan. This will cash flow. Number two, hey, bonus depreciation. You can't get that in bonds or stocks. I mean, that's a huge advantage. Bonus depreciation is something that people, look for. So there's still a lot of, great things to talk about in real estate.
Right. And then, so on our side too, on the money raised, we've been focusing on the kind of high net worth individuals, sophisticated investors as well. We've stayed away from the United States private equity or the family offices. Their money's way too expensive. They want your second born. And I like myself. So I don't do that. But we have been looking at talking to 2 different Israeli private equity groups, and also some 2 groups before COVID-19 out of China as well. So that's much cheaper equity if you're able to connect to those folks. The Israelis are phenomenal. That if you can raise money out of there, that's a great deal, because what they'll do is they'll come in for 90% of the equity, and then they'll give you you've got to hit a 10% pref to them, and then you got to cash them out by year 3. So this is definitely deep value add, but cash them out at year 3 at a 15% annual return. But once you do that, you own the 100% of the property.
Oh, wow.
Oh, yeah.
I mean, it's
That's
a
huge.
phenomenal deal. And so they get their 15%, they're happy, and you get whatever size of building you pulled off, which is just phenomenal. So, those 2 groups we've been talking to pretty heavily about that.
Okay. And can you, that you mentioned, and Jorge or Steven, when you're talking about private investors, are you getting any feedback into not wanting to invest, but because they're so conservative or concerned, not wanting to jump in the same amount and wanting to lower the amount in order to jump in? How are you doing any exceptions on that and lowering your limit, your minimum limit, or is it just as the same as it was before?
You want to start there, Steven? Or?
Nobody.
I guess my feeling is, if someone has cash and they just don't feel, certain about something, then I don't think it makes much of a difference between 25 and 50K. They're just not going to do it. I think it's a feeling, how do you, as real estate investors, we can underwrite risk, but how do you underwrite uncertainty? I don't know. You just can't, there's so many questions right now that nobody knows. And so I think that scares a lot of people. So I think it's either like more of an in or out sort of thing versus, hey, you know what? I think, instead of 50, I'll put 25. I just don't think it works that way right now.
Right.
I agree with Steven. And, most of the investors we're talking to, they're ready to go. They've got the cash there. They want to do it. They don't want to put it in stocks or in something else. And I feel like they're literally just waiting for, now that it's reopening, give it a week, give it 2 weeks, and they'll be ready to go.
Cool. Yeah, cool. Thank you, guys. Okay.
I think
Sorry, Kenny.
And if you have that deal, you'll raise the money. If the deal's good, you'll raise the money. If it's value add, go and do renovations, 4.5 cap, and I got to get $100 bumps to make my returns work, that deal's not in vogue today. It's
I was gonna say,
grandma's dying, operator screwed up the operations, they can't get out. If you have that deal, you'll raise the money. It doesn't matter whether it was like, oh, I'm on the sidelines, I'm off the sidelines. You'll just get bigger checks from less investors. But if the deal's good, you'll raise the money.
Right. I agree.
That's true.
All right. Appreciate it, guys. So, we've been talking about wormhole entry, then operations, then acquisitions and money raising. Now, thinking about on the exit side, what do you see, or where we are? Of course, there's still a lot of uncertainty, like we all know. But do you see, for example, on the multifamily side, where do you see the demand? Do you see it going up? Do you see it stay the same? Do you see it going down? And do you see any other sector on the real estate jumping in, either during or after this self-storage or any other type of asset? Do you have anything to add there?
Yeah.
I mean, I think long term, because if interest rates remain low, I think you won't see a big cap rate expansion, except for the value add deals. The distressed deals, you're going to see a cap rate expansion, I think, a little bit. But stable deals, I mean, give it a year or two, I don't think you'll see. I think we'll be right back where we're at on the multifamily side. I mean, and speaking of a different class, I mean, I love our little dollar stores. I'd buy as many as I could of those things because they're essential. They're staying open, and they're the sales record for the quarter because all the toilet paper they sold.
They stay open and
full. I was wanting you to dig into some of that today because that is like like you said, an essential service, and you were booming at this time where everybody else was counting their losses.
Right. Yeah. And the lenders are lending on that. Like I said, that was the 3.6% interest rate we locked in on a new acquisition of that. So
what's the cap rate spread on something like that today?
Well, don't tell anybody, Czar, but we're buying them for 8.5.
Hey, that's good arbitrage, man. Congratulations.
Just between us, 70 here. Cool. Anybody else? Any thoughts on multifamily market by itself in terms of growing or staying the same
or
going down?
If you guys have pivoted or added to what you're doing now because of COVID-19?
Mm-hmm.
I still think multifamily is a real safe place to be. I mean, it's just in general. I mean, the demographics are there, you know. I mean, there's a big, lifestyle change that has happened over the past 10 years. And I see that I read an article from, I think it was rentcafe.com, and they said that the past decade in general, right, because every asset class is different, but you had these younger kids, the millennials, they really fueled this wave of multifamily living, this lifestyle over the past decade. And then apparently, according to Rent Cafe, they seem to think these baby boomers are going to fuel the next 10 years. So, I mean, they say that there's a lot of baby boomers that are undersaved on retirement. And if all hell goes to in a handbasket, then they potentially could sell their homes to fuel their retirement. And where would they end up as multifamily? I think that's what the article said. So I think multifamily is good. And sticking on the baby boomers, I have it in my calendar to start looking at assisted living in 2025, because that's when the first year of baby boomers turns 80. And so I think that sky's the limit there for the next from 2025 to 2040.
I agree. I think if you enter that wormhole and you are looking back 6 months, maybe a year, let's say a year from now, and you look at the different assets, real estate assets, multifamily is going to fare, I don't want to say the best maybe, but definitely up there compared to the others. Obviously, I think retail is going to have a drastic change overall. Hospitality, I don't know. I want to think that's going to come back. It's going to take a while, but
I think it's really about defining the investment strategy and the horizon for that. So, like, the one thing about multifamily is it always has some of the downside risk covered, because it's transitionary housing between good or bad times, and the government's always going to have. Politically, the government's going to save housing regardless of whether it's multi or single family. So you're going to have liquidity injected there. But it's also a pretty good strategy to zig when people are zagging. And if you're going to get into stuff that's distressed, I mean, there's going to be a lot of hotels that are distressed, a lot of shopping centers that are distressed. Right. And that's when you lean in, is when there's blood in the streets and nobody wants to buy it. You're going to make the best deals. I mean, retail's not going to go away 100% entirely. Yeah, you may have less demand, but for instance, San Antonio's retail was already 96% occupied because we're still not with the times. Not everybody's ordering online. They still wanted to go to their shopping center. Eventually, that'll come back, even if it's 3 years from now. If you bought a beat-up retail center that's in a good location, and you can lease it up in 3 years. Well, you'll do really well, and you'll dump it, and you'll make a bunch of money on equity appreciation. Your cash flow is going to be probably anemic, but that return profile for that deal is good, right? So zig when people are zagging, and multifamily got a good downside risk protection from the government intervention. And I think that unless the government goes bankrupt, continue to do that. But I think, multi will be a safe asset class as compared to the others, but safe doesn't make big outsized returns. If you want to buy distress, the distress is going to be in retail, hospitality, oil and gas leases. Go buy some of that stuff, and everybody's going to be like, yeah, I was stupid. Why didn't I buy that? It was just like in 08, 09, anybody that bought in 08, 09, of course they were going to make money. Well, anybody that bought in 2021, any hotels and shopping centers, oh yeah, of course they did well. So zig when people are zagging.
I think that's great, man. I think you got to be brave to do that, which, hey, I'm all for it. But I would also say buying multifamily in an area that's driven by one of those would be a good play as well. Safer, good play.
I agree.
Mm-hmm. Maybe movie theaters? Any ideas on that?
I don't know.
That was a guess.
I was done with those already.
I don't know. Yeah. I'm thinking about those 99-cent stores that Kenny was talking about at 8.5 caps. While treasuries are at 0.5%, I think that's
Kenny owns them all. Owns them all already.
I know, man. Come on, Kenny, give us some.
He's gonna delist Dollar General off the public stock market.
All right. So go ahead. Yes.
We're at about an hour and a half at this point. So let's maybe take some questions, and we want to allow the attendee to ask their own questions. So, we want to try that concept. Does anybody have any questions that they want to ask the panel at this point?
I've been including them on what I've been asking so far. One that I've seen that I'm pretty interested in as well is from the underwriting standpoint. What do you recommend, or what are you doing on the tax assessments, calculating or underwriting taxes moving forward? Are you looking at a devaluation, or are you looking at business as usual? Tax behavior, property taxes specifically, I'm talking about.
I just had a conversation with my tax protester, and we came up with a strategy. You can make a case for going back to the tax authority and saying, hey, with everything going on right now, we think that cap rates are going to expand, and that's going to devalue our property a little bit. And also, I didn't think that I threw in my 2 cents about collections. And, at collections, I'm very happy about. We came in at 93% collections for the month of April. And I'm confident that's going to continue. I think it's August I'm more worried about, when all the stimulus dries up. Who knows what's going to happen? But we're gonna try to slip in, the month of April at lower collections, and make a case about expanding cap rates to try to get our tax bill down a little bit.
Yeah, it's a fine dance. You always tell them like, "Oh, I overpaid way too much for this property."
It's the tax man,
So if you're buying assumption deals, typically the property taxes don't go up. Because they don't really have anything to base it off of. In Texas we fight it yearly. We all know that. In some of our other states we don't, because it's such a low number, and you only adjust it every 3 years. So it depends on where you're at. But in Texas, we fight it every year. I think they're going to have to be less aggressive on the property taxes, but we're not going to underwrite that until we see it.
For acquisitions, I would say 95 to 100% of purchase price. The deals that transact are unlikely to be the high value deals, and there's going to be some political implications with taxing authorities not having the dollar amounts and the resources, so they're going to push really aggressively for values. Values for San Antonio came out, and they're still pretty aggressive. Is our underwriting as of January 1st. So, but on new acquisitions, 100 to 90% of purchase price, because you're going to likely buy at values that are lower than where they were, and you're going to fight to probably have to say, here's my contract, I bought it lower than what you're assessing it at, and you can continue to fight them, but until they say, hey, show me your contract in a downward moving market, then they'll take that comp, and then they'll throw it in the trash, so that they don't compare you to others around them.
Yeah.
That was their tactic when it was going up. Is here you go, here's the new comp, but when it's going down, throw the comp in the trash.
It worked only one time, right? The first time.
Yeah.
All right, guys. So what we're going to do, again, we're 1.5 hours into this. Want to give you, 1-2 minutes per person, just to, if you have any closing statement, and we're going to post your contact information so people can do a screenshot if they want to. So let's start with Jorge. If you can, let me share the screen with yours. There you go. It should be showing right now.
So what am I doing? Sorry.
If you any last words
last words.
just
Gotcha.
closing.
Gotcha.
And tell people what's the best way to get a hold of you, and this is your moment to
I got it.
shameless plug.
Okay. Well, first of all, thank you guys for inviting me to this panel. I mean, I think it was great stuff. And as far as my overall thoughts, I'm pretty optimistic on multifamily real estate. I wanna see us reopen things like we're getting ready to, and just do it safely. Everybody, follow the guidelines, and hopefully avoid that second wave. And I think if we do that, comparing this to 2008, 2009, like we were saying earlier, the big difference is the economy. We were one of the top economies of all time.
Oh yeah, for sure.
So if not the top, and there was no financial crisis that caused this. It was a virus that came and threw everything off. So yes, there's going to be some effects that are lasting, but I don't think it's going to be to the point where it's going to take that long to rebound. So I'm definitely going to be acquiring properties. I'm going to be looking for those opportunities. We're already looking for those opportunities. And we're going to keep doing our thing in multifamily. That's what I got. If you want to contact me,
thank you so much, Jorge.
You got my information there, but shoot me an email is probably the easiest, or follow me on social media. My email is Jorge, Jorge, @elevatecig.com.
All right. Thank you, Jorge. I appreciate having you for the second time, actually. Jorge was one of our first guests, and we're delighted to have him again. Steven, if you want to take the next.
Yeah, sure. Thanks for inviting me too. I mean, it was great. Nice to talk to other people in different cities about what's going on. But I'm pretty, long-term optimistic about multifamily. One thing that I've been studying recently is, all this, money supply that's been expanding so crazily over the past, decade, and I'm trying to do some research into that to find out how that could potentially affect real estate in general. I mean, it's a very strange thing when you have the government that is printing so much money and not think that there's going to be long-term consequences. So how does that tie into real estate? I think that that'd be a great webinar in itself, about all this stuff that's going on with the Fed and the government and all this money that's being created. So that's pretty much what I'm focusing on right now, trying to study that. I like history, but I'm pretty bullish on multifamily in general. And yeah, if you guys want to get a hold of me, please feel free to reach out. You can get a hold of me through my website, www.michelsonsinvestorgroup.com, or send me an email at steven@michelsonsinvestorgroup.com. And thanks for having me once again, and good luck, guys.
Thanks.
Thank you so much.
Oh, I want to say one last thing about Steven. Make sure if you get a chance, go to his website and take a look at his blogs. His blogs are very intriguing, very thought-provoking. I'm like his biggest fan. I told him I will be his president of his fan club. So
checks in the mail, man. Checks in the mail.
Yeah. So take a look at his blog. You know, he does some curation, but then there's some that he's created himself that are great. So take a look at those, please.
I appreciate that, Jesse. Thank you.
Yes.
Bring the beard back.
Thank you, Steven. Thank you. Yeah.
I will.
All right. Sorry, if you want to sort of throw a few closing arguments.
Yeah. So, listen, I think that the overall status is that most people are going to believe rates are going to be lower for longer. You're going to have operational challenges, but the market has a way of correcting itself by not having new construction. So you're going to have some of the competition on the back end slow down, and new builds are likely
That's a good point.
Go away. You're going to see occupancies tighten up, and you'll see rental growth happen. So it's not forever, and a couple years is not that long a time to get those investments probably back to where they were operating. If you bought in the last 2 or 3 years, you probably maybe lost 5% equity in the last, 5% per year for the last 2 years. Maybe you didn't time it correctly, but you should probably have at least enough staying power. You really have to move your revenue down 30% before you really get in trouble. So I think most people in Texas aren't going to be in that much trouble. You know, at the end of the day, zig when people are zagging, be there when the opportunities are there on your lap. Answer the brokers.
And loaded.
Yeah, answer the brokers whenever they call you, because they probably have a deal that's probably worth looking at, and just return the calls, because at the end of the day, it's a relationship business, and that good deal goes to the next caller that answers next time, and that offer may need to get written today for that distressed seller. So if you're going to play that game, make sure that you're active. Don't be a wait and see, be a wait and give feedback if it's not your deal, and say, hey, here, describe exactly what you're looking for, and know what you're looking for to be able to tell the brokers what to bring you, because they'll bring you that deal eventually. And my
excellent point.
Are, you know, everything will go through and everything will eventually recover. It's just a matter of time.
Right.
Thank you, Zar. We really appreciate having you too. And last but not least, again, Mr. Kenny Wolf.
Closing the party. You started the party. Now you're closing the party.
Yeah, thanks for I finally got on. Appreciate it. So Zara, call me. I'll pick up. I promise.
And I'll call you back, Zara. Sorry.
Wolf Investments. Find us on social media. We got a YouTube channel. We do a weekly Q&A live on our Facebook account under Kenny Wolf. So check that out. Thursdays, noon Central. We've done 4,000 units over 9 years, a little over 9 years. Owner of a management company, bought that about 2 years ago. It's been really helpful to help increase our operations and fine tune all that. But guys, appreciate it. Thanks for having me on, and definitely zig when others are zagging. I'll tag on to Zar's comment there. So.
All right. Well, thank you guys. We really appreciate our guests and the people that stood by with us and hang on for this time. We really appreciate both Jesse and I, and here's also our contact information. If there's anything we can do for you or make you connect with any of our panelists as well, we would. Our goal is to help bringing education and value to the community. So please feel free to reach out. We'd love to. And Jesse, anything you got?
Yeah, we plan on creating some more of these brainstorms. So stay tuned.
It's time to celebrate your 1-year anniversary. I'm gonna go have a beer.
Yeah, bro. I'm gonna like.
Yeah. Well, guys, thank you again. Thanks, everyone. Stay safe, please. Just follow your rules and guidelines, and hope everyone in your family and friends stay safe. And until the next one, have a good night.
Take care, guys.
Yes.
Good night.
Bye.